Digant, good to have you. Why don't I take off from what Kunal was talking about? The fact that there is that lag within the broader markets to play catch up with the frontliners, but there is still select opportunity, be it in defense. We're seeing auto stocks as well playing catch up, cement. Are there any individual sectors that you see playing catch up?
See, I think the 2 years of COVID, okay, which is 2020 and 21, we saw a big party in all the sectors which were export led because the US was doing well, the Europe was doing well, China was the first one to come out of COVID. I think now what we are seeing, as you just mentioned, that the rally is not broad based. I think that a lot of things which have to do with the export mix, that's the space which is not doing well. Be it IT, be it chemicals, be it textiles. Where we have seen a good fair bit of correction, and then they did not participate in the current leg of up move. So I think the domestic leg of the entire market looks really good. So whether it is financials, whether it is auto, whether it is the domestic consumption, the FMCGs or the food companies, I think this is a part that should do well. And then partly, see, you look at the data coming from China. So the China is really slowing down. And if China slows down, we can have some bit of control on the inflation without the US having to raise rates or do the quantitative tightening. So in a way, markets are parting because of that. Markets thought that US inflation will only be tamed by raising rates, but now we have China slowing down. So we have a 6 to 9 months of a breather before which the inflation may spike again. So that is why the markets are parting. I think for Indian investors, it's best to be domestic focused because falling inflation helps us and the domestic economy is completely opening up. So be it, all these stocks in the shopping sector or food sector, banks, autos, I think all these should, at least the results should be good in all these sectors.
Now, what is the global setup this morning? In case you've just tuned in, well, good morning. SGX is up 57 points. Crude prices have now decisively slipped below $100, and I'm saying decisively. Whatever has been coming on the global front, the crude bulls are getting a sweat on the brow, so to speak. SGX is up, crude is down, FIs are buying, US markets were mixed last night, and domestic institutional investors are just not selling. So we are going through that phase, folks, where FIs who sold the same shares because of desperation in May, in June, in July, they are coming back and they're buying the same stocks, minus IT, at higher levels. Look at the price action in HDFC Bank. Where are the merger concerns? It's gone to 1500 now. ICICI Bank, intraday graph, or maybe this month's chart. And by the way, ICICI Bank, Digant, has got this reputation of underperforming, but it is now only 100 rupees away from an all-time high.
Absolutely. Yeah, so Nikun, that's what it is, right? That financials, we've had so many interviews over the last 6 months that, the setup was great, the results were improving, but it was just the FI selling which was holding them back. And, now the reason FIs will come back is because there is some bit of comfort that maybe another 6 to 9 months, there is no very big tightening in the US. And yes, if FIs come back, there is no way that the financial sector does not do well because the other setup, except the technical setup of FI selling, the entire setup of the banking and NBFC space was great, all the while the last 6-8 months. So now we are seeing all that happening. Maybe in this next round, there will be the likes of Axis and Federals of the world, which will catch up. The ICICI Bank has, always given spectacular results and the share price has also responded. But a lot of areas will probably catch up now.
Digant, why is there such a large gap between big banks and small banks? Why the large has only magnified in this fall?
I think, Nikunj, this is a theme which somehow working for, last 10 years, maybe more. Last decade, it was a little more gradual. We still had heroes coming out of, an IndusInd, Yes Bank, Edelweiss, Piramal. Time and again, these fast-growing companies would spring up, but then over the next few years, they would give up a lot of their competitive edge. So I think the setup of a bank is such that unless you have a really, really great deposit franchise, you cannot keep on lending at lower rates. And see, now banks have become, sorry to use that word, but it's slightly a platform business kind of a thing, that if I have an HDFC Bank salary account, they are trying to give me 20 other services. So the more and more and more I transact with them, the more and more entrenched I become. Now just take an example of a City Union Bank. Like, they hardly have a credit card offerings. They will not have UPI banking. They don't have personal loans. They don't give out, two-wheeler loans. So if I was a customer of City Union Bank for say last 20 years, but for all the new kinds of services, I'm not sure if City Union Bank has, changed their technology stack or hired enough savvy employees who can launch these new products, scale up these new products, go outside Tamil Nadu and become big. So I think that is what is playing out in the minds of investors, and we can also see that in the PNLs and the profitability and growth profiles. The large banks have been quite, had corporate banking problems, but otherwise, HDFC, Bajaj, Chola, all these large companies, they've been fairly consistent over the last 5-7 years. So I think this is a trend we all have to probably digest and live with, that the large banks are so well invested in technology, people, and whatever the new customers, the old customers need, that small banks really don't have a very big chance to fight. Maybe City Union Bank will have a bounce back for the next 1 or 2 years because we are looking at a cyclical upturn. But 5 years from today, again, City Union Bank will probably become more irrelevant than what it is today. Same goes for IndusInd, IDFC, all other, mid-sized, or so to say, banks who have not achieved scale on the deposit side.
And Digant, what about then a bank like RBL? We saw the first quarter performance. We've seen there's going to be a management change as well. There are those that believe in the quarters to come, we could be hearing more about stabilization. So just seeing the recent stock movement of RBL, it still has a lot to catch up. Can that be an opportunity?
Yeah, and I think, see, all these IndusInd Bank or RBL, Yes Bank. See, there are two aspects to it. Okay, one is what happens to RBL in the short term. Yes, in the short term, see, they've gone through a lot of pain. The stock price is cheap, and we are looking at a cyclical recovery in the economy. So I think in the short term they may do okay. But then if you ask me what is the real strength of RBL, their deposit franchise is absolutely average. They have to give high rates to earn, to get deposits from the customers. On the lending side, they had two core USPs. One was the credit card plus microfinance business, and the second was the structured finance or structured corporate lending. Now, structured corporate lending as a business completely collapsed after IL&FS crisis. So the question is, where does Ratnakar Bank or RBL Bank earn income and grow from? So they don't have enough capabilities, and they lost out on these crucial 3-4 years because they really need to digitize and have their offerings which are as savvy as any other bank. So I think Ratnakar Bank, RBL may give you a nice stabilization kind of a pop-up, but 6 to 12 months down the line, you will again be asking, okay, what's the long-term USP of this bank? They do not have a USP in personal loans. Their borrowing costs are so high that they cannot lend to prime customers. So they will always have to take more risks to earn some money. And the more risks you take in India, we've always seen that they come to bite you back. So at best, it is a cyclical trade, maybe 6 months, 12 months, 18 months, and then again the questions of long-term attractiveness of the business franchise will come.
Let's hear it out then from Rahul Shah as well of Motilal. Oswal Financial Services. What's his top fundamental stock idea within the banking space? Listen in.
One thing was very clear, I think, that I think financials look very promising, which I started in my interview also said that I think financials still will continue. So I think in that space, I think ICICI Bank, I think that what we've been asking our clients to buy. Second is, I think HDFC Bank. I think the stock has been underperformer vis-a-vis the entire banking sector. That can lead the rally from here. It's like very interesting, very good valuations which are available right now. So that is second stock. And thirdly, I think State Bank of India. The numbers were a little bit below estimates what the street was estimating, but I think looks like for next few coming quarters, numbers should be strong for the PSU bank. So I think.
Okay, we've been talking about as to how some of the large caps are taking lead, be it the Bajaj Financial Twins, be it Adani Ports, be it M&M, which has already seen a 29% move since the June lows. But look what's happening within the rest of the auto pack as well. Of course, there's Tata Motors and Maruti, which are also springing up. But even the ancillaries, and Apollo Tyres, for instance, in trade yesterday sprung up a good 6%. There was Escorts as well, which made a very solid 10% move. And Kunal, to think of it, Escorts was actually the poster boy of when the auto recovery began, right? Along with Tata Motors. And then, of course, slowly now M&M has replaced that. Making a comeback, a very strong move yesterday. Sustainable?
Sustainable. I would say sustainable, and I think possibly the stock should climb back towards its previous all-time high levels as well pretty soon. So I think the all-time high levels for Escorts is closer to 1920 odd mark, and there have been many special situations in between where the futures had gone into a deep discount, and such things had happened for Escorts, and that's where the stock remained into a corrective phase. But all of those have been in the past now for Escorts, and the stock is making a good stride, good comeback. After yesterday's move, the stock has clearly broken past about the first immediate hurdle and resistance, which is the 200-day moving average. So that was a very comfortable and a good sign for the stock as well over the near term. So expecting the stock to continue the up move, and the auto stocks and the auto pack at large to try and get into that zone of outperformance. There have been, what started off with M&M and then TVS Motors is now trickling to the other stocks. Like Eicher Motors is also inching towards its previous major highs. Maruti has come back about the 9,000 mark as well. So expecting that many of these auto stocks should continue to march up higher.
I'm going to pick up a sector which we normally don't talk about, since the theme is autos. Well, autos and tires, they have to go together. If cars are selling, tires are needed. And if tires are needed, then let's look at some of the tire stocks. Which are the prominent auto stocks in India? SEAT, MRF. MRF, by the way, has grown without diluting. That's the history of MRF. And Apollo, which has a bit of a global flavor to it because they've done acquisitions and they do get business from Europe. Then there is Balkrishna Industries, heavily, not a large market share. I mean, Balkrishna Industries is a specialized company. They get a lot of business from Europe. They're making trucks, tires for off-roading, which is that the big tires, which essentially those giant trawlers they use when they go inside the mine. So those are very specialized tires. They are not the tires which essentially are used. They
for passenger vehicles.
They are off-road tires. Let me put it this way. But the reason why I'm bringing out tire stocks, and Digant, I'm coming to you right after I flag off this point, is that for tire companies there are two components. These are not great return on equity businesses because they are, even though tires are sold as brand now in India, they are still commodity businesses. Two important raw materials for tire company are rubber and oil derivative. Oil prices have collapsed and rubber prices have also come down, and auto sales have revived. And even if EV happens, tire to lagega bhaiya. Digant, is it a good time to buy tire stocks?
Maybe again, Nikunj, this is again the same question you asked for small banks versus large banks, that, in small banks, there is a good setup for 16, 18, 24 months, but long term is a question mark. So similarly, see in tires are getting more and more efficient. The frequency at which we replace our tires is actually coming down. And, the tire manufacturers themselves are making better and better tires over the years. The roads are getting better. So it is just that, see, replacement demand in tires is almost 70% of the total demand. So though we may feel that, new vehicle selling should be good for tire stocks, the larger market is on the replacement side of the tires. And I think the replacement cycles are getting longer rather than getting shorter. So very, very long term, obviously tire stocks, don't cut the compounding kind of returns. They don't fall into that bucket. But yes, in the short term, we have all the cylinders which could actually fire, which is the new sales of vehicles coming back. Second is the commodities. Okay, so they need carbon black, they need oil, they need rubber. Now, all these three have started correcting. So we will see a good demand and good margin uptick for, another 6, 12, 18 months. And of course, the medium term outlook definitely looks good. But then again, in the long term, it's always better to be with stories which are stronger and which keep getting stronger. So MRF, it's always been a brilliant company, but, it's very difficult to build a case that you will make humongous returns from the valuations at which they are currently trading. CAT maybe yes cheaper, and probably more returns could come to CAT. And yeah, there's this JK Tire which has some of the problems in the international side, but stocks are extremely cheap. So you're right. There is a good case, in the medium term at least, to be built for tire stocks.
All right, we were talking as well about some of those AMC plays earlier this morning. HDFC AMC is in the news. Yesterday, the stock as well was a buzz. Digant, if you had to cherry pick within this space, what would make your list?
Okay, so see, AMCs are plays on the financialization of the Indian markets. That Indians will invest more in financial assets and less in physical assets. So the best stock in this space is not listed, which is NSE or the National Stock Exchange. So obviously we have to try and find ideas in the AMC space or in the broking space. I think AMC space has gone through a lot of pain in the past. I wouldn't say that the pain is over, because see, now there is a lot of do-it-yourself customers who have come. There are so many new AMCs which are coming. Okay, there is a Navi AMC. You hear someone getting a mutual fund license every month. So I think the competitive pressures are there. The pricing is coming under big pressure in mutual funds. So I'm not very very excited about the mutual fund space. But having said that, yes, they are cheap. Because in the last 3-4 years they have absolutely done nothing. They have borne a lot of pain. Here I think I would like to stick with HDFC AMC in this space if one has to just select one stock, because they have the distribution might which nobody else has. Maybe SBI mutual fund and ICICI mutual fund have the similar distribution might, but they are not listed. So amongst the listed plays, clearly if somebody is going to be able to protect their margins and profits and growth, it is going to be HDFC AMC. So I think we'll also see some uptick in the numbers in the coming quarters. But yes, on the very long term, I think something like an NSE or a
Right.
CDS is a much better play.
Absolutely. They can't stay with us.
Right. I'm going to go back to our chartists now. I was scanning the list of the 52-week high stocks, and Kunal, I'll come to you with this one. We were talking about, JK Paper yesterday. Once again, at a one-year high, this stock is more than 100% up. We're supposed to be going digital, but JK Paper, other paper stocks flying high and up. What's the chart check on that? And the other one is Chalet Hotels, up 65% year to date. Recently, a lot of fund managers have been talking about Lemon Tree Hotels. In fact, we'll have Parthu Keswani of Lemon Tree Hotels today on the show. But for these two counters, a chart check.
Yes, as I was highlighting earlier, that many of these smaller sectors, they've managed to find good momentum for themselves. West Coast Paper, JK Paper, many of these stocks have come back to their all-time high levels and shown a very strong degree of momentum. And it's interesting because the momentum is not just off late that the stocks have been flying up high, and then the correction phase has not been seen for JK Paper. In fact, from the 2020 lows, the stock has done exceptionally well. It was almost at 65 in 2020, and the stock is now almost at 450 odd levels. So it's a remarkable return for a stock like JK Paper, and the consistency of the stock is the hallmark of many of these smaller sector names. West Coast Paper as well has done exceptionally well for itself. So I'm expecting that this momentum and a trend would continue. But the only question and the catch is that with such high and steep returns into the stock price, the risk reward to initiate a fresh buy is skewed, and that generally is not a good sign for a short-term trader to enter the stock. So it's best that for guys who've been holding on to those counters, they can continue to hold on with a decent amount of trading stop loss and then continue to ride the trend higher for these paper names. Chalet Hotel as well, I think the stock has done reasonably well. It's more like Indian Hotels, which from the 2020 lows has gone through a very consistent kind of an up move. Same is the case with Chalet Hotel as well. The stock trading above 350 odd mark for itself. So expecting that the entire hotel space would continue to march up higher. Indian Hotel is still a preferred bet for me, but I would believe that Chalet Hotel and Lemon Tree, they could also have their phase of outperformance for themselves.
Scanning through the list in terms of some of the outliers, one big outlier yesterday was UTI AMC. Talk about a coincidence or the buzz that there is going to be in stake sale. UTI AMC yesterday clocked volumes which were extraordinarily high. India Bull Housing, again, one of the top traded counters yesterday, up 3.5%. Naresh, technically, how should one approach India Bull group of stocks? They have become very, very different stocks now. They are no longer the bull market stocks. They are no longer the poster boys. Do you think one should strictly avoid into India bull stocks given the recent bout of volatility?
So one of the things one has to be very clear when you're trading names which are highly volatile is to have a stop loss. So even if you participated in India Bulls housing at various prices, if you had a stop loss, you would be out. You can't be buying these names without a stop loss because when the trends go down, they continue lower. So yesterday, India Bulls real estate finally came up on the volume radar. The stock saw one of the highest volume ticks in the last 3-6 months. Price crossed a recent swing high. Now, the way to look at it is the stock is at say 76, 78 yesterday. One would keep a strict stop loss at 70 and then go ahead. But if one is not keeping a stop loss, it becomes difficult to be trading such stocks. So my view is we can trade most of the stocks which are there, which are liquid. If one has a stop loss. So out here, position sizing and stop loss is very important. So India Bulls real estate yesterday was one of the highest volume ticks. It actually is indicating that the trend has changed, and it could go all the way to 100, 120 also if this works out.
We've been discussing how the broader market is yet to play catch up with the large caps. So let's get some mid-cap ideas going. Kunal, what's on your mid-cap list?
So from the mid-cap end, I would suggest a buy on Action Construction. I think that's IEX rather. I think that stock is looking quite charged up on the short-term charts. In fact, yesterday the stock completed a classical inverted head and shoulder pattern on the daily time frame charts. 169 was the breakout point for this inverted head and shoulder pattern. The stock has closed comfortably above those breakout levels. So would suggest a buy. 182 as a target. Stop loss 167.
All right, Naresh, let's get your top recommendation within the broader markets.
So that would be a buy on Tata Power. The stock is making a range breakout. For the last few sessions, it was finding resistance around that 236, 237 mark, which is where it topped out in August as well as in July, as well as in June. Yesterday was the first time it has crossed above that 236 mark. That indicates a short-term range breakout is done. I would expect a target price of 260 in the short term, a stop loss to be kept at 232.
Kunal, one stock that was buzzing yesterday, and that was because of a block deal, KKR exiting with its 27% stake in Max Healthcare. We saw a big price movement, almost of 9% plus. What's it looking like when it comes to these hospital stocks, especially Max?
Specifically, Max Healthcare, I don't expect a major kind of a trend reversal for the stock. In fact, the stock has this tendency of giving those single day strong price upticks, but post that we've seen the stock getting into a corrective phase. Similar happened for Max Healthcare. I think the month of April mid, where the stock had risen up by 10% plus, but then the stock topped out the subsequent day, and from there it actually corrected more than 15 to 20% post that as well. So I'm expecting very similar kind of moves for Max Healthcare. Don't expect the stock to get into a stronger degree of momentum, and the charts could be more coherent like what we've seen earlier as well.